So getting to know someone that you're investing with, I think, is really important. And whether you acknowledge this or not, I think inherently you're investing in the person almost more so than you are in their strategy. Obviously, you gotta like the asset class.
All right, guys. Hey, welcome to another exciting episode of the Practical Wealth Show. And so I have Mr. Jacob Vanderslice from VanWest Partners, and what we're going to talk about is going to teach you a little about today is investing in self-storage during an economy of change. And so we're going to talk about a bunch of topics around that, and just how he's thinking about money, what he's looking at, and some tips you can glean from that. Okay. And Jake, so let me tell you a little about Jacob. So Jacob is the principal at VanWest Partners. He's a Denver's, we're just talking about skiing and stuff before we start recording, based investment firm focusing on the acquisition and management of self-storage centers and other opportunistic real estate throughout the United States. And so Jacob, welcome to the show. Tell them what I didn't tell them, and let's teach people a little about money.
Sounds good, Curtis. Good to meet you. Thanks for having us on today.
Thank you.
Yeah, you mentioned we're based out of Denver. 25 degrees this morning. It's afternoon for you in Philly. We got started in real estate about 16 years ago. And for many years, we primarily did residential fix and flips. We did a ton of them all over the country, mainly the Denver metro area, but we did them in the Southeast, the Southwest, Central Valley of California, all over the place. And then kind of during this journey, we got into commercial real estate in about 2014. And we started doing adaptive reuse retail projects, which is basically converting cool old buildings around town into breweries, restaurants, yoga studios, coffee concepts. We've sold some of those, held on to others.
I think I've seen some of your stuff too. I saw a bunch of that kind of stuff in Denver. Yeah, that's really cool. Okay.
Yeah, we've done a bunch of, we didn't own them, but we leased to a bunch of breweries around town. It's a fun business. But this adaptive reuse retail concept isn't very scalable. There's only so many, busted, underutilized buildings in a given MSA you can buy and, add value to and reposition. So for a number of years, we had looked at self-storage as something we want to get into, and we studied it for a while. And we like that it's historically downside protected. It's historically recession resistant. And it's got this kind of good blend of downside protection, as I mentioned, but also durable recurring revenue streams and quantifiable and reasonable upside. So we looked at it for a while. We did our first deal in 2015, and that was a ground up development project here in Denver. We did a couple others around town. We expanded into Milwaukee in 2016. We did 4 value add deals out there. And then we kind of kept going. Most of our deals, or rather all of our deals, up until about 2019, were done in single asset syndications, and we launched our first storage fund in 19. We did our second fund in 21, and we're currently on our third fund. So we like the asset class. We think it's a good spot to be during times of uncertainty, and we've got a lot of uncertainty, I think, going into the new year here.
Yes. I want to kind of talk about the uncertainty for a second. So, and I love at the end, I want to get into the funds and how people can contact you. But let's say I'm a intermediate, or I'm already a real estate investor, and that appeals to me where I think I want to learn how to do it myself. Okay. I'm a glutton. I don't know if I say glutton for punishment, but I'm going to do it myself. And what's an important first step? So you saw that this is I think a good market. So if I was looking at that, what would maybe some thoughts on people thinking about, they're already kind of got some stuff going on, and they think that's a cool asset class they want to research?
Yeah, well, there's 3 ways to invest in self-storage. One way is to buy a publicly traded REIT stock. I think the single advantage to a stock is you've got liquidity, and really that's it. You're not getting any of the tax advantages. You're not participating in really a lot of important aspects, I think, of investing in real estate by just buying a REIT stock.
Right.
So that's one way to participate. The second way is to invest in a private real estate vehicle, like a private syndication or fund.
Mm-hmm.
And the third way is to go out and do your own deal. And I think
Mm-hmm.
your question revolves around the third way. So if you want to go out and be a storage operator, how do you get started?
Mm-hmm.
Well, things to consider, first of all, are how are you going to fund the deal? So there are very cheap, inexpensive deals out there, and I think they're cheap for a reason, right? They're small net rentable square footage. They're tired. They're probably in a population center that's not growing. They have a lot of capital improvements probably need to be completed. They're inefficiently managed. So it kind of depends on your financial situation. But let's say you've got money laying around and you can go out and you can find a deal.
Mm-hmm.
So one of the first things we look at when looking at sites are the supply ratios in the submarket, meaning how much supply is in the 1, 3, and 5 mile trade radius as relates to the population.
Mm-hmm.
And that's expressed typically in square feet per capita. So nationally, the average is about 8 square feet per capita. And historically, if you're buying in a market that's above 8 square feet per capita, it was oversupplied. If it's under, it's undersupplied. Well, that's still kind of a rule of thumb. But markets with higher supply ratios can often support those higher supply ratios if the rents are low,
Mm-hmm.
because more people can afford to store. So the first thing you got to look at is does a market make sense from a supply perspective? And the second thing you want to consider is there an opportunity if you're buying an existing facility? Is there an opportunity to raise rents? That's a big piece of our value creation strategy. Is we find deals that are undermanaged with below market rents, and we raise rents over time through either capital improvements and giving our customers a better facility, or layering ancillary revenue streams in. So supply ratios are the rents below market, and if you find a deal that makes sense from all those perspectives, the third thing you got to consider is how are you going to operate it? Who's going to manage this?
Mm-hmm.
So you've really got two options in the management side. One option is you can hire a third-party management company to run the facility for you. That's a whole other podcast right there.
Right.
There's a lot to consider there. Or you can manage it yourself. And if you want to get in the business, and you've got the capital and you've got a deal that makes sense, I think self-managing is a good idea because it helps you learn the business and how to be an operator.
Mm-hmm.
If you just buy it and kind of hand the keys off to somebody else to run it, you're not going to learn as much. You're not going to be in the thick of learning the operational aspect of bringing a deal with below market rates up to market rates, controlling expenses, marketing, the software side of it. So management's a big consideration. But if you're going to go out and do a deal,
Mm-hmm.
You want to be able to have a story to do more in that submarket. You can always go out and do one deal in one location, but in self-storage, if you can actually aggregate facilities in a given submarket, you end up saving money on operating expenses like payroll specifically.
Mm-hmm.
You can amortize a lot of those fixed costs across a larger number of units and a larger number of facilities. But just like creating wealth in any asset class, it's not easy, right?
Mm-hmm.
It's there's a lot of misconceptions about self-storage. Things like no tenants, no toilets, no problems. That could not be further from the truth. It's very operationally intensive. It's almost like the hospitality business to a degree. People are not, in most cases, they're not staying overnight in a storage unit. Sometimes they do. They're not supposed to. Obviously, hotels they are. But it's similar to hospitality because, number one, it's very customer service oriented. And number two, all of our leases are short term. So the revenue management is very dynamic. And you can respond. That's a kind of a good and a bad thing to a degree. But one of the good aspects of it is if you're an efficient operator, you can respond real time to supply and demand changes in your facility. So for example, if you've got a unit type that's really full, everyone's on a month-to-month lease, you can raise rates on that unit type and probably not get any move-outs. And likewise, if you have a unit type that's below market, or rather below market on physical occupancy, you can raise your physical occupancy by dropping your rates and filling those units up and then kind of increasing those rates over time. So the revenue management aspect is interesting. The downside to that, which may not be a downside, is your revenue streams are sort of tough to predict, right? It's not like signing a 10-year industrial lease with Amazon where you can probably forecast, within a, 0.01% of what your income is going to be over that term of that lease. The revenue management's very dynamic. You've got seasonality in the Midwest, which you don't have as much of in the Southeast, and all these different factors you have to kind of account for when you're underwriting a given property.
So it's more than a notion. Let me ask one other question on that. This is for my DIYers. I want to, if I'm looking at that, like you're saying, you got to find them. Do you, like, real estate? I don't know. Not well. There's channels, there's networking, there's business brokers, there's whatever. How do you find? Let's say I'm in Philly here, and I'm or like in a probably more spread out area, and I'm interested, and I want to look for something. How do you do that?
Well, we source deals a couple different ways. One way, we kind of applied from our single family fix and flip days. We do a fair amount of direct to seller marketing. So we'll send them business letters that basically say, hey, we're not brokers. We're interested in looking at your facility. We might be able to pay you a price that you're pleased with. So give us a call. So we've gotten a fair number of deals doing that over the years. But our primary deal flow channel is broker relationships.
Okay.
It's rare that if a deal is widely marketed that we can compete,
Right.
because there's so much cheaper money out there than ours with lower return requirements, just lower thresholds for risk. So broker relationships are really important. A fair number of our deals the last few years have come to us, and I don't use this term loosely because it's thrown around a lot, but a fair number of our deals have been off market, meaning the market doesn't see it. We got a relationship with a broker. They give us a call and say, hey, this guy wants to take his deal to market. This is the pricing guidance. Can you guys get there? And we say yes or no. And if we can, then we close and he brings us the next deal. So I would encourage you to look up local self-storage brokers. That focus on that product type. I think a commercial broker that doesn't have familiarity with the business is not generally going to add a lot of value. Somebody who specifically focuses on that line of business, I think, is going to be important, and just ask them to bring you deals.
Okay.
And you could also look at stuff that might be marketed, but it's inefficiently marketed. Maybe someone's got a cousin that's a Remax broker, and they take the deal to the market on the MLS, and no one looks at it because the MLS is not catering to self-storage buyers. So you could look at deals that are more inefficiently marketed. But yeah, deal flow is, despite the rising rate environment and the uncertainty, deal flow is still pretty challenging right now.
Okay. So now I want to talk about that, but what I want y'all to hear is the relationships, the off market. Jacob, business is business. So what I want people to hear is, if you're trying to buy, you're basically buying a business, right? If you're trying to buy commercial real estate, it's I've heard this repeated: broker relationships, direct outreach. Because Jacob, what I always tell people, I don't care what business you think you're in the marketing business, right? And
Yep.
So you've got to just stop fighting it, right? You're in the marketing business because you gotta, you gotta market, you gotta track deals, you gotta convert, and you gotta, it's what I call it before, during, after, but you gotta get them, you've got to do it, and then the management is the after, right, of that. And those are all really specific skill sets, right? And so we'll talk about why. Okay, now that you know how it works, we don't like REITs. I'm not, because the Wall Street gets all the profits. Okay, right? So you put up. I always tell people, with Jack Bogle, who just speaking about Malvern, said that in the equities you put up 100% of the money, take 100% of the risk to make 30% of the profits. Is there any profits at all? So
Right. Yep, I like that.
So let's talk about the we're in an economy of change, and why you like this for your business, for your clients, and why do you think this is a good asset class to look at going forward?
Well, obviously the headline right now is inflation. As of today, I think this morning, the numbers came in a little bit lower than everybody thought they would. So the Dow is soaring. But self-storage, by virtue of the fact the leases are month to month, actually to a large degree benefits in an inflationary environment, because we can raise rates more effectively over time. Now, we're still feeling the pressures on the operating expense side. We're paying our people more. Our vendor contracts are going up, things like landscaping, snow removal, utility bills. But our revenue is going up faster in this inflationary environment. So we think storage is a good inflationary hedge. And I think real estate in general, if financed responsibly, is also a good inflationary hedge. Interest rates have gone up a lot, obviously, relative to where they were a year ago. But relative to the history of debt, interest rates are still reasonably inexpensive compared to what they've been historically.
Mm.
So whether it's storage or something else, locking up a hard asset with short-term leases, with long-term fixed rate debt, is a great hedge against inflation. Another reason we like the asset class during a changing economic climate is historically, if you look at the financial crisis, if you look at COVID, self-storage has been one of the better, if not the best performing asset classes during a softening.
Mm-hmm.
And the reason for that is when there's an economic softening, life events happen for our customer base. Things like marriage, divorce, getting a job, losing a job, upsizing or downsizing a home, relocating to a new market for a new job. Really, life changes are demand drivers in storage. And when there's a softening, there's a lot of life changes,
Right.
and demand historically will increase. So those are kind of two of the reasons we like the asset class as we go into this very unpredictable period over the coming quarters and coming years.
Right. I think that, one of the things, Jacob, we teach our clients is to think from a macro standpoint. And you can't have a plan that only works when the sun is shining, right? Markets go up. That's what I mean by the sun is shining. And
Yep.
Markets go up, they go down, they go sideways. But if you're playing defense, so now you've got something that works is no matter what, good economy. Okay, great. Bad economy. They've got kicked out or their house, or we've used them because our kids are in school and I don't feel like carrying all their junk home during the summer. So we put stuff in storage for at least 3 months down in North Carolina, where both of my kids are. So that's where I'm looking. So now I've heard some stuff and I'm looking, wow, all right, there's nobody here. They've got this electronic thing and there's a number you can call. It's like, wow, this is a good business, so I'm always analyzing stuff to get into that, whether I want to get into it directly, which way I don't want to do that. I'm lazy. And but I could see where, okay, you want to make money either way. So I think that's exciting. So folks, you want to think about, all right, how can I grow and protect my wealth, right? My personal economy.
You talked about defense a few moments ago, and our notion of defense is cash flow.
Mm-hmm.
And if you have long-term debt that's not maturing over a short period of time, that's fixed, and you've got recurring revenue streams and you got cash flow, you can weather the storm.
Mm-hmm.
If the value of your asset base, for whatever reason, declines, and you don't have to sell, you don't have to refinance, but you're still producing cash flow. You don't like the fact that it declines, but maybe you don't care because you still have cash flow.
Right.
Does it matter what a deal's worth if you're not refinancing or selling anytime soon, as long as it's producing a reasonable above market recurring revenue stream? And to a degree, it doesn't matter.
Doesn't matter at all.
It matters when it comes time to monetize.
You can't eat equity. I always tell people, right? You can't eat equity. So net worth to me is a lag indicator. The lead indicator is, what am I, can I go on vacation, stay on vacation because I've got reoccurring revenue where that comes in? Because we talk about, Jacob, this is kind of why I like talk about this kind of stuff. You want to be financially independent, right? And so I always use the Jim Rohn definition, being able to live like you want to live from the income from your personally invested assets, right? And, whatever the asset class you like, or, there's, you don't have to, Walmart sells more than one thing, right? So, you can be in different asset classes, but I think that has to be your objective. And so if you focused on that, that kind of narrows your focus of what you want to look at, right? And it helps you because, hey, is this going to get me, we call it in our system, excuse the language, getting to a position of FU, and which is passive income twice your expenses. So I don't care what you buy. I'm agnostic, just as long as you're, making money so that you can, your family secure in good times and bad. And, this definitely sounds like it fits the bill. And
yeah, wealth, in my opinion, is not net worth.
Mm-hmm.
Wealth is cash flow. Just to your point earlier, let's say let's say I deed you a $10 million mansion in Malvern. We were talking about that earlier.
Right.
Um, and so you get this mansion, you got a free and clear. Well, you can't pay the taxes, you can't pay the groundskeeping, you can't pay the expenses. The deal produces no revenue. And the only way to monetize that net worth you now have is to either put debt on it, and now you have a mortgage payment, or to sell it.
Mm-hmm.
So I think people get so focused on net worth as far as kind of the benchmark of whether they're successful or not, and they sometimes forget that I think cash flow is more important. If you have passive investments, not necessarily passive, but if you have investments that are producing recurring revenue streams that you can actually put in your pocket that increase over time, by default, your net worth is increasing.
Mm-hmm.
But you can actually taste that net worth because it's paying you every month or every quarter, whatever the case might be.
Let me go back for a second. I just thought about something. So how did you like start and move yourself into real estate into this? Like, were you working somewhere else and so like I'm tired of this, I want to get into real estate? I would like to get the your origin story. You were bit by a radioactive spider and
yeah, certainly. Yeah, it's a combination. No, in my early 20s, I was a career firefighter and I had a bunch of time on my hands. And I started doing residential deals on my days off. And I got busy doing those. And I quit my full-time job, and I've been unemployed ever since 2006. And it was a learning experience, because imagine a young guy with no financial experience whatsoever getting into real estate in a heavy way right before the financial crisis, right? Made a lot of mistakes, got beat up pretty badly, but I learned and I would do it again. So that was kind of my first start. And I think about those days every day in terms of downside protection, because when the lights go out, they don't go out slowly. They go out just overnight when there's a downturn. I'm not saying that we're on the precipice of something as substantial as the financial crisis was, but we'll see what happens. I think this bull run and this era of irrational exuberance in real estate and many other asset classes is over. It's maybe not obviously over right now, but it's going to be obvious in the coming quarters. And I think
all bubbles pop.
Okay. Yes, they do. Yes, they do. And this, to a degree, has been a bubble. And I think a lot of deals, especially in our space, we watched get acquired for substantially more than we offered, with underwriting assumptions that we believe, at least, to be untenable and unreasonable. Just overly aggressive pricing assumptions, overly aggressive revenue growth, big valuation assumptions on exits. And as you know, the model will tell you whatever you want it to. You can make any deal into a deal if you put the right number in the spreadsheet. So I think there's going to be some pain in the space, even though it's historically recession resistant. I think we'll see some pretty interesting opportunities in the coming quarters that we haven't seen for a number of years.
When you think about that, because one of the things that I talk to people about is I think people are undercapitalized. Like, the number one problem I see with families and business owners is lack of access to capital. They just don't save, so that, like, right now, with Buffett sitting on some crazy number like $100 million in cash, and Apple's in a lot of cash. And I think that, when you see something, if you have money, you can take advantage of that. Do you see that if you're what they call a dry powder, and these people that overbought and they can't maintain it, if you're ready and you know what you're looking at, that represents opportunity for you if you're liquid and you can do it? Do you think like that?
Yeah, what we do, I think having liquidity on hand to take advantage of upcoming opportunities is important, but I also think you have to balance the time value of money. Let's say early COVID, early 2020, someone said, man, this is bad. I've got a bunch of cash. I'm going to wait for a year to deploy my capital and wait for things to get really bad. Well, for the most part, they went the opposite direction, right? Real estate values skyrocketed, interest rates dropped, cap rates compressed. And I guess the point I have in saying that is being liquid is always a good thing, and being positioned to strike when you see opportunity is a good thing. But you also can never time the market, right? If you're waiting for a massive downturn to deploy capital or go out and do a deal, that downturn may never happen. We may have a continued small correction and then another run up in values. And if you're not in the game, you're not creating wealth by sitting on the sidelines. So it's kind of a balance. There's never a good time to buy, and there's never a bad time to buy.
So stay in the game.
Stay in the game.
Advice. Keep looking.
Stay in the game.
Keep shopping because it doesn't cost any money to shop, and just keep running your numbers.
Yep. You know, in the most irrationally exuberant market, there's still going to be a deal out there in a given town or in a given submarket. And in a massive correction and downturn, obviously there's going to be deals too. So I don't think it ever makes sense to kind of stop and just wait to time the market, because you can't time the market, right? Right. I know a lot of our investors who went big into the equities markets in December, thinking, man, this run up is going to keep going, and now they're down whatever they are, 30% in some cases, depending on what you bought. So you can't time it. It just can't be done.
And it doesn't cash flow. Again, they're investing for capital gains. Yes. It doesn't cash flow.
Yes.
Tell me, let's talk about, let me think. Tell me, I want to get into the mindset. Like, so are any things you're reading or what you look at as you're, keeping your mind towards moving forward and, keeping your attitude right or learning new things? What's exciting? What excites you right now?
Well, I listen to a lot of podcasts, as I'm sure you do too, and you host one. I read a lot of articles on REIT performance, on real estate performance, and my entertainment. I've got 2 little toddlers, so I don't entertain myself too much. But I read a lot of historic nonfiction. But what I'm seeing as far as what the pain and the opportunity is going to be in 2023 is there is a massive amount of floating rate debt on the street right now, in all asset classes. Storage, though, is certainly one of them, and so is multifamily. And by floating rate debt, what I mean is somebody bought properties at inflated pricing, say 2 years ago, and their interest rate's not fixed. It floats based on some kind of index. And they went into the deal with probably a 2.5% interest rate. And in their model, maybe they stress it up to 4, thinking, it's not going to get much worse than that. So depending on your loan type and when you bought, in many cases, the interest rates on these floating rate loans have more than doubled from the time they were originated. So these borrowers have a few different issues. One is obvious. Their interest carry is twice what it used to be, or their mortgage payment is doubled. The second issue is they might be in technical default with their lender. Believe it or not, you can be in default on a commercial loan if you're still paying your mortgage, if you're not meeting certain things called loan covenants. And loan covenants could be, certain cash in the bank or cash flow above your annual debt service. And if you trip one of those loan covenants, technically they can call the note due.
Wow.
So you're going to see a lot of loan covenants get tripped, I think, in the coming quarters. And these borrowers are not going to be able to refinance these loans because the interest rate going into fixed debt would probably be higher than their already high floating rate interest rate. So they can't refinance. What are their options? Well, they're going to have to sell, right? If they can't make their cash flows work, if their lender is all over them from a technical default perspective, they have to sell. And the price that property is going to command is probably nowhere close to what they thought they were going to get in their model. So I think you're going to see 2 things. You're going to see a decline in transaction volume because sellers who don't have to sell aren't going to sell. But the sellers who do have to sell will. And the deals we're going to see trading, I think, are going to be much more heavily discounted than they've been historically. So that is my wrong crystal ball leading into 2023. But I think that's the big sort of ticking time bomb out there right now is just the amount of floating rate debt that's out there.
Okay. I like that. So let's tell them about your VanWest and the opportunities with the syndication, and also tell them, about the funds.
Sure. Yeah, we've really got 2 strategies right now. We're doing self-storage ground up development within the context of single asset syndications. And then we've got, we're buying existing facilities within the context of our 3rd fund, VanWest Storage Fund 3. And the reason we separated the 2 out into different vehicles is, at least we believe, development is just too different of an animal to layer into a fund structure. It's a different risk profile. With that increased risk, though, comes potentially increased returns. So our development line of business, we're buying raw land, we're building a new storage facility, we're leasing it up, we're stabilizing it, and then we're monetizing it when that's appropriate.
Okay.
In our fund vehicle, we're focused on only buying existing storage facilities that are undercapitalized and undermanaged. So we'll buy deals with high physical occupancy, but below market rates, and bring those customers up to market rates over time. We'll also buy deals with very low physical occupancy. And the year one business plan on a deal like that would be to grow physical occupancy versus raise rates. So those are really our two strategies right now. And the main difference between a fund and a syndication is a fund is generally a collection of assets. So you're inherently a bit more diversified, both geographically and from a cash flow perspective. You're buying into a portfolio that's got deals in North Carolina, Georgia, Florida, Oklahoma City, Illinois. And a syndication, you're only in that one deal. So if that one deal doesn't go according to plan, there's no other income streams to kind of shore that up. But in a fund vehicle, let's say the fund's got 20 properties, and for whatever reason, which they always do in a given quarter, one or two deals fall behind forecast from a revenue perspective or occupancy perspective. Those are balanced out by the other, say, 18 deals that are on or ahead of forecast. So if the fund ends up buying a dog, which we certainly don't think we have a dog, but maybe we do, and if we do, we won't know it for a couple of years. That dog is kind of balanced out by everything else that's performing well. So we've got syndications, we've got our third storage fund, and the risk and return profile just kind of depend on the investor. If an investor wants a shorter path to cash flow and distributions commencing sooner, the fund vehicle is a little more interesting for an investor like that. But if an investor doesn't care about current cash flow, but wants more gross dollar upside and a higher multiple, development could be more interesting. So those are really our two strategies and kind of two lines of business right now.
So what comes to mind is who's who. So let's go back to the fund. If I'm hearing this, or I shouldn't, because we're not soliciting, we're just educating, but what's a good, let's talk about the fund. Who's a person that should be, I like this, what he's talking about. What does that person look like? I don't know if you can get into what, do you have to be accredited or non-accredited, that kind of thing.
Yeah, that's really the only common theme across our investor base is accreditation. So we're a 506c fund, which means you have to be accredited. And for those of us listening who don't know what that means, it means simply that if you're single, you got to make 200 grand a year and expect to make 200 grand a year for the foreseeable future. If you're married, you got to make 300K a year, same thing. Or you have to have $1 million in net worth outside your primary residence. So it's not all of those together, it's one or the other. And if you check one of those boxes, you're accredited. But beyond the accreditation, our investors are all over the country, all different walks of life. We have a music producer out of Nashville. We've got dentists, doctors, attorneys, real estate entrepreneurs, family offices, high net worth individuals. And our typical investor profile is somebody with a fair amount of active income. They've got a small business, they've got a law practice or a dental practice, whatever the case might be. And they don't have the time to go out and do their own deal. And they want to participate in our asset class, but they don't want to do the work to go participate in it.
There you go.
They invest in our fund. They're getting most of the upside. They're getting tax advantages. And it's a good vehicle for somebody who doesn't want to do the work to go out and be a storage operator.
Because it is real estate. So if they're doing it, then the tax advantage is passed through. So if I've got a high W-2 income and I'm accredited, this might be a good thing, either, especially outside of my IRA, but a lot of people have a lot of their capital inside of IRAs. So we didn't really get into it. You could create a self-directed, roll some money there, and you could still participate in this,
Yeah, we have millions of dollars of capital that's in self-directed IRAs through various custodians who are good at private real estate, self-directed IRAs. On the tax advantage side, just to drill down on a comment you made a moment ago, all of our depreciation flows through to investors pro rata with their contributed capital. So for example, if somebody's 1% of the fund, they're getting 1% of the fund's depreciation. Now, the only way they can take advantage of that depreciation, unfortunately, is if they have other passive gains in their portfolio, they can use that passive loss to offset that passive gain. Unfortunately, that passive loss cannot offset their active income. So as you mentioned earlier, if you're getting a W-2 and you're a high income earner, unfortunately, that passive loss will not reduce your AGI as it relates to income. But if you have other passive gains in your portfolio, you sold a stock and you made money, or you had another syndication that round tripped and you made money, you can use those passive losses to offset that.
Right.
Which is attractive. But
talk to your tax planner.
Yep. Talk to your big asterisk there. Talk to your CPA.
Right. Yeah.
But whether or not you have other passive losses, what that depreciation will typically do when the fund is generating positive cash flow, say you're getting an 8% current dividend yield, historically standard depreciation on a current basis will wash that out from a taxable income perspective. So a $100,000 investor might be getting $8,000 a year in distributions, but their K1 will show very low, zero, or negative taxable income. So real estate's a great vehicle for creating cash flow that, at least on a current basis, you're probably not paying taxes on.
Yeah, guys, taxes are number one wealth transfer. So you got to, incorporate that thinking in everything you do. And now that we're giving tax advice, but you need to think about it. And, investing is a team sport, right? So in this case, if you're thinking about Jacob and VanWest, what you're looking for if you're going to syndicate is vetting out good operators, doing your due diligence and making sure you've got a good operator that has a track record and that takes care of their client's money. Okay, like your own.
I cannot stress how important that point is you just made. There's a lot of people who just kind of got into the business recently, and they've got a good track record because they've kind of floated up on the rising tide. So getting to know someone that you're investing with, I think, is really important. And whether you acknowledge this or not, I think inherently you're investing in the person almost more so than you are in their strategy. Obviously, you've got to like the asset class, but you're really investing in people and the team's ability to go out and execute the strategy and deliver the returns that they're targeting. So I think getting to know your sponsor is very important. And I also think that if you've got whatever $500,000 laying around and you want to go invest in private real estate vehicles, I think spreading that around across multiple sponsors is a really important thing to do and a good way to diversify. Even if you're diversifying with multiple storage sponsors, I would still consider you diversified, because even though you're in one asset class, inevitably, one's going to perform better than others. And I think I think it's important to not put all your eggs in one basket, for sure.
You got to think portfolio. This is your portfolio. Here's an asset class within because we talk about, Jacob's 4 asset classes, right? Business, real estate, paper, and commodities. And so what do you like? What are you interested in? How would they, I know you got to go, and I want you to tell, so think of this in a question that just popped up, and then I want you to tell them how to be in touch with you. So a lot of people don't know what questions they ask. So when you say check out the operator, how do you do that? How do you get to know the operator, because you don't even know what questions you should be asking, or that really brought up an interesting point. Is how do you do that?
Yeah. I think asking for financial statements and quarterly reports, I think one question you should always ask is, send me an example of how you report to investors. And if the example they send you is a 1-paragraph email that says things are going well, we'll talk to you next quarter, that's probably not somebody you want to work with. I think having that sponsor demonstrate their willingness to provide absolute and detailed transparency on every aspect of the business is really important. And you don't have to be a real estate finance expert to necessarily understand this stuff, but I think doing a sanity check on what the assumptions are the sponsor's making that drive the return targets. One term that gets thrown around a lot in real estate and investing in general is a term called IRR. And we won't go too deep into it, but IRR stands for internal rate of return. And it's basically it's a return calculation based on a time-weighted series of cash flows. So IRR accounts for time as far as return goes. Now, if you're looking at a deal just through the lens of IRR, let's say you're looking at a deal right in your right hand, it's got a 20% IRR. and a deal in your left hand that's got a 15% IRR, you inherently might gravitate towards the 20.
Mm-hmm.
But what's driving that 20? Are the assumptions that are being made reasonable and achievable, or are they relying on a big refinance in a short amount of time to return capital? Are they relying on a compressed cap rate valuation when it comes time to sell?
Mm-hmm.
Is revenue growth exponentially higher than it should be? And obviously, you're not a real estate finance expert. If you're, you probably have enough to be dangerous if you're investing in syndications, enough knowledge rather. But just kind of high level, understanding the assumptions that are driving the return profile, and looking at it through the lenses not only of an annualized return or IRR, but also through the lens of a multiple. And by multiple, I mean, and I think multiple is more important than IRR in most cases. Multiple is simply how much profit can you expect to realize over the life of the vehicle as a percentage of the capital you invested? So a 2x multiple, for example, would be if you put 100K in, you get 200K back. A 1.5 multiple would be if you put in 100K and you get 150 back. A 1 multiple, which kind of sounds funny, means you broke even. And less than 1 multiple is you lost money. So nobody wants to do that. But I think blending the IRR with the multiple metric is really important as you're evaluating different opportunities. So if I told you I can give you a 2 multiple over 5 years, you would probably think that's a reasonable multiple over a reasonable amount of time. That's an attractive investment. If I said the same multiple, but over 6 years, you would probably think the same thing. Reasonable multiple, reasonable amount of time. But the IRR in the 6-year scenario was going to be materially lower than the 5-year scenario because of that elapsed time that went by.
Right.
So blending that IRR metric with the equity multiple metric, and then kind of understanding high level what's driving those assumptions is really important as you evaluate investments and sponsors.
I think that what comes to mind is that one of the things that we teach, Jacob, is we call the 3 rules of investing: invest in what you know, or invest in knowing, invest in what you could control, and don't chase returns. And but what I was, and I had a friend of mine who I can't think of the end of the book right now, but he a lot of the book was in you don't always have to know, like, if you want to scale, to me, syndications, but what you said to me, that's investing in knowing how to ask good questions and then vetting out strategic partners to scale into asset classes you don't have the capital or the time to learn how to do. Like, most people that are successful, the dentist, somebody that's making good money in their deal, you need to focus on that, right? And then vet out good partners, and you perform in your unique ability. You let Jacob and his team perform in their unique ability, and keep it moving. That's what I see, because you can't know everything, and you get distracted, right? And then you don't do anything. And so that's, it's funny because I do these shows, Jake. I have shiny object syndrome. Oh, that sounds great. Oh, that sounds great. Every week, maybe 3 days a week, because I might do, and I have to stay focused. No. My business is good. Let me focus on that. And then I will pick a few of these people and let's do some strategic alliance thing, when I'm ready. And I think that when they're hearing this, so we're throwing all this stuff at you, but that's the thing, am I there? Do I like this space? Let me reach out. Let me have a conversation. So I just wanted to kind of wrap that up. So I appreciate for that level of detail. How can they find out, follow you, find out what you got going on? Where would you like them to go?
Well, we always love to talk shop about real estate. People can email me, jacob@vanwestpartners.com. They can go to our website, vanwestpartners.com, or they can hit me on LinkedIn, Jacob Vanderslice.
Okay. All right. So we'll put all that in the show notes. Jacob, anything I forgot to ask you, did you want to say? That's my catch-all.
No, I don't think so. I had a blast with the conversation. I want to expand briefly on one point you made earlier. If you're considering investing in real estate, whether it's self-storage, multifamily, single family, and you've been considering it for a long time and you haven't taken action, I think the worst thing you can do is nothing. Indecision and the opportunity cost of indecision cannot be overstated. So I think taking a risk is very important. It's got to be a mitigated risk that you understand. It needs to be a downside protected risk you have to understand. But there's no perfect deal. There's no perfect opportunity out there. And if you're kind of waiting on the sidelines to take action, nothing will ever happen on the sidelines.
Right. Well, we say activity produces knowledge. Knowledge does not produce activity. So you got to, Emerson said, if you want the power, you got to do the thing. So
That's
get
right.
out there and go do your thing. So, Jacob, this is awesome. Thank you so much for dropping these jewels on my listeners. And so I thought this was a lot of fun. So we'll so enjoy. If this makes sense, we're going to put all his contact information in the show notes. Jacob, thank you so much for joining us on the Practical Wealth Show.
Had a blast, Curtis. Thanks for having us on.
Pleasure. All right, guys, go out there and make it a prosperous day.